Good evening. Please come to AS-1. AS-1 is called Disclosure of Accounting Policies. As the name of the standard suggests, the standard is all about disclosures. The standard is about disclosures. The standard is all about disclosures. And disclosure of what? Disclosure of accounting policies. Disclosure of accounting policies. This is one of the basic accounting standards. All other standards will take guidance from this standard. Okay, all other standards will take guidance from this standard. This is one of the fundamental accounting standards, and that is why it was issued earliest of all. Accounting Standard 1, Disclosure of Accounting Policies. So come to your booklet, paragraph number 1, Applicability of Accounting Standard. This standard is mandatory. Mandatory means compulsory to all the enterprises. Those enterprises in India which are applying accounting standards, all such enterprises are required to follow this accounting standard 1, disclosure of accounting policies. Is it right? As I have told you, this is one of the very basic accounting standard, and it prescribes the guidance to be followed while disclosing your accounting policies. One question is still pending. What is accounting policy? Keep thinking, I will come to that. The question for you for thinking is, what are accounting policies? Okay. So AS-1 deals with disclosure of significant accounting policies. AS-1 deals with disclosure of significant. Significant means important. Important accounting policies. While doing accounting, you follow accounting policies for a large number of events and transactions. Are you required to give a disclosure of all such policies? Will I write in my financial statement, this pen purchased is accounted at cost, this calculator purchased is written off in P&L account in the same year in which it is purchased? For each and every item you are not supposed to write, otherwise your financial statement will become too voluminous. Too much details will confuse the user of financial statement. Therefore, we have to disclose significant accounting policy. What is the meaning of significant? Important. Something the knowledge of which can influence the decision maker. That is why it is called significant. AS-1 says you have to disclose significant accounting policies which the entity has followed in the preparation as well as presentation of financial statement. That is your recognition, measurement you have used. While doing accounting, we use lot of recognition and measurement principle, and how these are presented in the financial statement. Financial statement means balance sheet, P&L account, cash flow statement, and notes to account. So you have to choose accounting policy for presentation in the financial statement also. So whatever you are going to do, you have to give disclosure of significant accounting policies, right? AS-1 deals with disclosure of significant accounting policies followed in preparation, that means at the time of their accounting, as well as at their time of presentation in the financial statement. What about the choice of accounting policy? Choice of accounting policy. I am going to ask you a question. Who decides? Only question relating to AS-1 will be asked. Who decides the accounting policy? Can I write AP in short? Who decides the accounting policy? I will give you option. Option A is management. Option B is auditor. Option C is article clerk of the CA. Option D, government. Who decides the accounting policy? Who decides the accounting policy? Any query relating to AS-1 can be asked. Which entity follow which accounting standard is a part of different chapter? That will be answered in a different chapter. So most of the student are right. Shivam Gupta, Raghuram, Falak, Vajra, Kunal, Akhidev, Sumit Singh, Sanket Jain, Saurabh Chauhan. Management decides the accounting policies. You are right. You seem to be an intelligent student. Okay. The management decides the accounting policy to be followed. This is my entity. I am the best person to decide what will be the accounting policy to be followed, whether inventory should be valued using FIFO method or weighted average method. I know my business better than the auditor and the article clerk and the government. Okay? And it depends on the circumstances in which the enterprise is operating. So let us take some rough example to get an idea. That suppose there is a doctor. A doctor also has to apply accounting standard. Every business enterprise in India has to apply accounting standard or Ind AS. Ind AS is a different ball game altogether. It is in CA final. But for the time being, we will assume entities are required to apply AS. Doctor buys a car and he uses this car only to go to his clinic and come back. There is a tour operator. His business is to take clients or passengers in car throughout the day. Sometime he will go from Mumbai to Goa, from Goa to Vishakhapatnam, Vishakhapatnam to Chennai, Chennai to Kolkata. Will they follow same accounting policy as far as their businesses are concerned? The answer is not necessary. The doctor will drive the car only 20 minutes a day. Tour operator drives a car 20 hours a day. So they may have some different policy with respect to depreciation, residual value calculation, useful life calculation, method, etc. So it depends on circumstances in the organization. Now directly I am asking you a question. You are a learned student. Please tell me, what are accounting policies? What are accounting policies? What are accounting policies? Anybody wants to contribute? What are accounting policies? So accounting policies are specific accounting principles. Accounting policies are specific accounting principle. Example of principle is, those who are interested will keep writing. Inventory is valued at cost or NRV, whichever is lower. Whichever is lower. Inventory is valued at cost or NRV, whichever is lower. One student has said accounting policies are a specific accounting principle applied by the clerk of a CA. The last part was wrong. First few lines were okay. So inventory is valued at cost or NRV, whichever is lower. That is an accounting principle. Okay, that is a principle we have decided. At the end, all my inventory, I will count, I will calculate the cost, I will calculate the NRV, whichever is lower, I will take. Another example of principle, current investment. Current investment will be valued at, come on, you will answer, lower of dash and dash, cost and fair value. Very good. This is a principle. We have decided that our current investment will be valued at cost or fair value, whichever is lower. And method of applying those principle. Now understand the difference. You are saying inventory will be valued at cost, but then how the cost will be calculated? So there are some methods to calculate cost. As per AS-2, cost can be calculated by applying FIFO method, by applying weighted average method, or in some cases by applying SIM. So now the student will definitely ask me, what is SIM? So please reply, what is SIM? If you have studied AS-2, then answer, otherwise don't worry. SIM means specific identification method. Specific identification method. So first my principle is to value inventory at cost or NRV, whichever is lower. To calculate the cost, there are methods available. So I will decide which method I will follow, FIFO or weighted average or specific identification method in preparation and presentation of financial statement. So let us revise together. All of you will shout at the top of your voice. Accounting principles are, accounting policies are specific accounting principle, specific. That means for this kind of transaction, what policy I have to follow? Specific accounting principle, method of applying those principle in preparation and presentation of financial statement. So that is called accounting policy. In case of business, there are situations where multiple accounting policies can be followed. And that is why the standard says, whatever accounting policies you will follow, more than one policies are possible for the same type of event and transaction. Institute cannot stop you from following multiple policies. However, institute has asked you to disclose the significant accounting policies. Okay. Example of areas where different accounting policies can be followed. Some example I have written, some you will try. For example, valuation of inventory. Valuation of inventory, you will either follow FIFO or weighted average, and you can also mention here SIM, specific identification method. Dheeraj was right, Thanga Lakshmi Surya was right. Treatment of goodwill, you can follow different policies for goodwill accounting also. Like for example, goodwill may be amortized, goodwill may be impaired. For amortization, you have to decide the period over which it has to be amortized. So different companies may use different policy for further accounting of goodwill, and they need to disclose it. Then accounting of retirement benefit. Accounting of retirement benefit, for example, accounting of gratuity, accounting of PF, Provident Fund, accounting of pension. Okay, there is a separate accounting standard to deal with retirement benefit, that is AS-15. You will find there are different methods of accounting of retirement benefit. Then valuation of investment. In case of investment, first we have to decide current or long term. After deciding current and long term, current investment, the policy is cost or fair value, whichever is lower. Long term investment, the policy is at cost, unless there is permanent decline. Unless there is permanent decline, we will carry long term investment at cost. Then valuation of fixed asset. Here the issue will arise, which expense to be capitalized or not, which expense should not be capitalized, which expense should be capitalized, which should not be capitalized, how much should be capitalized, what will be the further treatment, etc. Whether we will follow cost model or whether we will follow revaluation model. These are different policies. Cost model means you will first calculate the cost, capitalize and only depreciate. Do not change its value if the market value changes. Revaluation model means only as the market value of that asset will change, we are going to revalue it upward or downward also. Next point, treatment of expenditure during construction. So learned student can also mention the standard name AS-13, this is AS-10, this is AS-7, this is AS-15, this is AS-14, AS-21, AS-28. These are some standards. AS-26, which deal with accounting treatment of goodwill. AS-2 deals with inventory. These are some example. One more example, you mentioned treatment of borrowing cost. Treatment of borrowing cost. Treatment of borrowing cost. Borrowing cost can be either capitalized or charged to P&L account. First of all, AS-16 deals with borrowing cost. Very soon you are going to learn, and it will tell you when should borrowing cost, means interest, be capitalized and when should it be charged to P&L account. So from this small list, you can understand that there are several areas in our field of accountancy where more than one accounting policies can be followed. Nowadays, we have reduced the number of options to follow different accounting policies, but still there can be areas where more than one accounting policies can be followed officially by the entities. So whatever policy you choose, make a disclosure. Now some query came about depreciation. What about depreciation? Earlier, depreciation was an accounting policy. Earlier, it was a part of accounting policy, but now it is called change in accounting estimate. It is called change in accounting estimate. It is an estimate now. Depreciation is an estimate. After the amendment was made in AS-10, after the amendment was made in AS-10, depreciation is now treated as an estimate and any change in method, rate, useful life, salvage value will be called as a change in estimate, right? Now we will come to paragraph number 5, need for disclosure of accounting policies. Before I tell you anything, the student will ask me why there is a need to disclose the accounting policy. What will be the advantage if the company discloses the accounting policy? So please reply. Please reply. We are going to cover today AS-1. Time permitting, AS-2 also we can start today. Anybody wants to answer why we need to disclose accounting policy? First reason is for better understanding of accounting results presented by the financial statement. So you can understand the financial statement better. You can understand profit better, financial position better, only if you know what accounting policy they have followed, right? And this is the important reason number 2, to enable users to compare financial statement of one enterprise through time. Through time means last year and current year. Current year, last year, sales 500 crore, sales 500 crore, cost of goods sold 350 crore, 400 crore, gross profit or profit 150 crore, 100 crore, right? Then other expenses 50 crore, 50 crore. So net profit 100 crore, 50 crore. Devangan is right for comparison. That is what I am doing. Now this company is telling you that see, our current year profit is double the previous year profit. Would you simply accept it? You will check why this figure is so different from other. Cost of goods sold means opening stock plus purchase minus closing stock. Now last year they had followed suppose FIFO. This year suppose they have followed weighted average. So because of the change in method of valuation of inventory from FIFO to weighted average, their cost of goods sold has changed from 400 to 350. If I do not disclose my accounting policy, if I do not disclose the impact of change in accounting policy, many users will think that company's performance is much better in the current year than the previous year, but that is not the case. The reason for a higher profit in the current year was a change in the method of valuation of inventory. If this information is disclosed, users will be benefited. Users can understand the performance better, can compare better if they are informed about the change in accounting policy and accounting policy. Similarly, you can compare the financial statement of two enterprises also. So this is Bajaj Auto Limited. This is Royal Enfield Company. This is Royal Enfield. Okay. Now same discussion. Sales 500 crore. Cost of goods sold 350 crore, 400 crore. Other expenses is 50 crore, 50 crore. So net profit will be 100 crore and 50 crore, right? Bajaj Auto will be saying that, see, our company is better. With the same revenue, our net profit is double that of Royal Enfield. Oh my God. And they don't, suppose they don't disclose their accounting policy. Royal Enfield says we are following FIFO method. Bajaj Auto supposes we are following weighted average method. Other things assuming same. Now the users can understand that the reason for a higher profit disclosed by Bajaj Auto Limited compared to Royal Enfield is not because there is extraordinary efficiency in Bajaj Auto Limited, but it is due to difference in the accounting policy followed for valuation of inventory. This will help them to compare the performance of two entities better. And the last reason mentioned here, requirement of the law also. Companies Act also requires under section 133 that companies will follow accounting standard issued by the institute. And one of the standards issued by the institute is AS-1 also. AS-1 is mandatory. So there is a mandatory requirement for disclosure also. Last point in your note is written, the view presented in the financial statement can be significantly affected by the accounting policies. Yes, depending upon what accounting policy you follow, the financial statement can speak different thing. Depending on accounting policy, either your profits can be too high or too low. Financial position can be very good or can be bad. Next paragraph is objective for selection of accounting policy. Who is supposed to select accounting policy? You have given me the answer. Management is supposed to select the accounting policy. Whenever you will select an accounting policy, your objective should be that the finance accounting policy should result into a true and fair view. True and fair view. That is, they should reflect what it is. There should not be what they call window dressing, that is showing a much better picture than what it is. So there should be a true and fair view, number one, of the financial position. Which statement gives you financial position? Balance sheet. And secondly, it must give a true and fair view of the profitability, that is performance position. Which statement gives you performance position? The P&L account. Accounting policies should be chosen in such a manner that they should generate true and fair view of balance sheet, that is financial position, and financial performance. Accounting policies should not be biased. Accounting policies should be neutral. They should not try to influence the user. They must try to present the picture as they are. Next is consideration for selecting accounting policy. Now our AS-1 is giving guidance. Guidance to whom? It is giving guidance to management. What kind of guidance it is giving? What factors should be considered? What factors should be considered when you are choosing a particular accounting policy? So first guidance is that as per AS-1, when you are deciding which accounting policy I should follow, apply the concept of prudence, which you have been taught in your 11-12 accounts also, means conservatism. Conservatism means profits are not anticipated, but recognized only when they are realized actually. Anticipated profits are not recognized. However, provision is made for all known liabilities and losses, even though they cannot be determined with certainty. This is a very good line. It says anticipated gain should not be recognized, but provision should be made for known losses, anticipated losses, even if we cannot calculate the amount with certainty. Some example of prudence. One example of prudence, as you have learned, that inventory should be valued at lower of cost and NRV, net realizable value. Cost is 100, NRV is 90, inventory will be valued at 90. Cost is 100, NRV is 100, inventory will be valued at 100. Now the question is why? Here I am recognizing anticipated loss, but here I am not recognizing anticipated gain. Here I am not recognizing anticipated gain. Okay. Here I know in case 2, when I will sell the inventory, I will earn 10 rupees. But that is when I will sell. That time I will realize the profit. Here I know the moment I sell the inventory, I will incur loss. So I am providing for that loss now only, before the inventory is sold. So now you will also give me some examples. Dear student, participate. One more example. Any answer? From student side, example of prudence. Example of prudence. Student will reply, yes, waiting for you. Come on, everyone. Example of prudence that you apply in your day-to-day accounting. Please reply. Nobody is replying. Just now you have seen AS-13, investment chapter. Investment chapter says current investment will be valued at lower of cost or fair value. What is this? I purchased shares of Reliance. Okay. Yesterday only I purchased for 2700 rupees cost. Today the market price is 3000 rupees. But I will not recognize that profit unless I sell that investment. But suppose yesterday I purchased Reliance share for 2700 and today is my balance sheet date and it is 2500. I have not sold it also. But then I will recognize a potential loss of 200 rupees. I will reduce the investment value by 200 because there is a anticipated loss. Another example which students have correctly said is provision for doubtful debts. Provision for doubtful debt we are providing because we are anticipating that the debtor may not pay. Then provision for bad warranty. Provision for warranty expense. Provision for warranty expense we are providing. Provision for warranty expense we are providing because we may have to incur some related expenditure. So this is an example of prudence. Provision for gratuity. I know that when the employee will retire, I will have to make them payment. How much I will pay, I don't know, but still I make the best estimate and make a provision for that. So all these provisions that you make is basically the application of prudence concept. So first thing the management has to keep in mind is prudence. Choose that policy which may result into recognizing anticipated loss but not recognizing anticipated gain. Anticipated gains are recognized only when they are realized. Then disclosure of contingent liability. Another example of this will be disclosure related to contingent liability. More about this we will study in AS-29. This is discussed in AS-29. Contingent liabilities are only disclosed in the notes. Liability which may or may not arise in future on the happening or non-happening of one or more uncertain future event, not wholly within the control of the enterprise. Oh, that was the long definition of contingent liability. So even contingent liabilities are disclosed so that the user can understand that there can be losses in future, but contingent liabilities are not recorded in the books of account because of certain things that you are going to learn in AS-29. Now next point to be kept in mind is called substance over form. Substance over form means look at the economic reality of the transaction and not just go by the legal form. Not just go by the legal form. In the eyes of law, it may be something else, but in reality, in substance, it has a different meaning. Best example, since you have studied lot of accounts, the example is hire purchase. Example is hire purchase. What happens in hire purchase? In hire purchase, ownership is transferred when last installment is paid. Ownership is transferred when last installment is paid. However, asset is capitalized in the books of the buyer. However, asset is capitalized in the books of buyer when the agreement is done. When the agreement is made. Okay. Now see, this is one very good example that you go to the dealer, you want to buy a car, you say I don't have the payment. Dealer says you pay 10 lakh rupees in 10 installments. Once you pay the last installment, we will transfer the ownership in your name. Today you only pay down payment 1 lakh. You paid 1 lakh, you took the possession of the car and you started using it like an owner. On the very first day, you pass an entry in hire purchase, car account debit, 10 lakh or whatever present value of 10 lakh, which is called cash price, to hire vendor account. Even though you are not the owner, on the first day only, you are recognizing the car in your book. What better example do you want? You are not the legal owner today. You will become legal owner after paying 10th installment, which may be after 10 years or 5 years. But in substance, in reality, you are the owner. Another example of substance over form is finance lease. In finance lease also, the lessee capitalizes the asset in its book. The lessee capitalizes the asset in its book even though he is not the owner. Even though he is not the owner, because in economic reality, he is like an owner. He takes all the risk and reward. Lessee bears all risks and reward. So if lessee is going to enjoy all the return and is going to take all the risk which normally an owner takes, he is in economic reality an owner, even though in the eyes of law he is not the owner. So this is another example of substance over form. Third example. Third example is consolidated financial statement. Third example is consolidated financial statement, which you are going to study in AS-21 Group 2 Accounting. But for the time being, what is consolidated financial statement? There is a parent company, there is a subsidiary company. In the eyes of law, this is one entity, this is one entity. But what CFS does, we prepare financial statement as if parent and subsidiary together are just one entity. So CFS is another best example of substance over form. In economic reality, a parent and subsidiary is like one unit only, because the decision making is with the parent. Resources are controlled by the parent. But in the eyes of law, there are two entities, so they will file two tax return. They will file two returns with the company authorities. But for the shareholders, for the investor, they will treat them as if it is one entity only. Okay? So now we'll see the example printed in your book. Example of substance over form. The rights and interest in the immovable property is transferred. Write down important. In the exam, it comes as a separate 4-mark question also. Rights and interest in the immovable property is transferred. That is, an agreement to sale is made. Buyer and seller have signed an agreement to sale, but the legal document, what is the legal document? Sale deed. Sale deed is the final document which completes the sale, which needs to be registered with the authorities, but the documentation, sale deed for sale, is yet to be completed. Now the question your institute will ask you, A and B has entered into an agreement to sell. A will transfer immovable property to B. Whether, and B makes some payment also to A. B makes payment, A transfers the immovable property, let us say a flat, to B. B takes the possession of the property. B starts using the property. B makes the payment also. Question is, how will A record this transaction if sale deed is not yet complete? Will A record it as, question for you, as a sale transaction or as an advance received from B? Sale transaction or advance received from B? In the eyes of law, sale has not been completed. In the eyes of law, because sale deed is not yet executed. However, in the eyes of an accountant, in economic reality, possession has been transferred, payment has been received, agreement to sale has been made. So don't you think economic reality is that the sale has taken place? So A will record the transaction as sale. In addition to sale, he will record the profit also. So the answer is printed in your book. This comes as a question in the exam, whether A should record sale or advance. So the answer is printed. A will record the transaction as sale. Another example discussed already, hire purchase, finance lease. You can also mention here consolidated financial statement. Consolidated financial statement. Now, dear student, I will keep you asking questions also. Good news is that questions are printed in your book. Answer is also printed. So you don't have to take the trouble of writing. We will focus on listening, learning, understanding. So there is a question number 1 printed in your book. You can see it is an exam question for 4 marks. Exam question for 4 marks, November 2010. Similar questions are asked now also, because AS-1 is the first standard and it is there since last many decades. So all questions on AS-1 asked by the institute are relevant still now. And there has not been major amendment in AS-1. Question for you. X Limited, only on the screen. Don't read the answer. Look at your screen. X Limited sold its building to Mini Limited for rupees 60 lakh on 30th September 2009 and gave possession of the property to Mini Limited. So this is the property, X Limited, Mini Limited. Property has been shifted. However, documentation and legal formalities are pending. Possession has been given. Amount has been received 60 lakhs. Due to this, the company has not recorded the sale and has shown the amount received and as advance. So what X Limited says, sale has not taken place. X Limited wants to record it as advance. The book value of the building is 25 lakh. Book value 25 lakh. Sale value 60 lakh. Do you agree with this treatment? If you do not agree, explain the reasons with reference to the accounting standard. As I said, such questions are asked in the exam for 4 marks. You have the evidence in front of you. So your answer will be, this question comes under AS-1. AS-1 says, while recording a transaction, we should look at the substance rather than the form. In substance, possession has been transferred, payment has been received. So therefore, X Limited should record it as a sale transaction, not as an advance transaction. So this is the answer in your book. So your answer in the exam has to be written very nicely. You will not just say record sale, don't record advance, over. You have to write, in the given case, economic reality and substance of the transaction is that rights and beneficial interest in the property has been transferred. That means all the necessary formalities which require one to transfer the property has been done, even though the legal title, which is a legal formality, has not been done. Hence, X Limited should recognize the sale and recognize a profit of 35 lakh. How this 35 lakh has come? 60 lakh sale value minus 25 lakh book value. In its financial statement, the value of the building should be removed from the balance sheet. Therefore, accounting treatment is not correct. And you write one more thing, write down one more thing below this, journal entry to be passed. Suppose your institute adds one more question. Pass journal entry. Then what entry we will pass? In the books of X Limited, bank account debit 60 lakh. 2. Building 25 lakhs. And 2. Please write down in your book, profit on sale 35 lakh. Profit on sale 35 lakh. You are right. Dheeraj is right. Sanket is right. So sometimes we have to think extra. Homework note down. Question number 2 homework. Please read and solve question number 2 as homework. Will you do it? Say yes. We will do it. We are a good student. Next consideration to be kept in mind is called materiality. Materiality means while choosing an accounting principle, an accounting policy, keep materiality in mind. Material means important. Important to decision maker. Information which is important to decision maker. Information which is important to decision maker of the financial decision maker who uses financial statement for decision making purpose. So our standard says financial statement should disclose all material item. Now the question will be, what is material item? Material means significant. Significant or important. So I have given you the definition of material. What are material items? Significant items are those items the knowledge of which might influence the decision of the user of the financial statement. So that is what they teach you in 11th standard accounts classes also. Say yes or no. Material item is those items the knowledge of which can influence the decision of the users of the financial statement. So these are such items which are what is called influencers. Influencers. Nowadays we have social media influencers. This is financial statement influencer. This is financial statement influencer. Okay. That means their presence or their absence can influence the decision of certain investor. They may invest in that company if they know it. They may not invest in this company if they know about it. Who has to decide the materiality? Question for you. Who decides what is material? Who decides? Everything is written in your book, but I am asking you extra question. Who decides what is material? Option A, management. B, auditor. C, law. D, article clerk. Article clerk of a CA. Who decides what is material? Anybody wants to answer? Who decides what is material? Come on. Who decides what is material? Reply. So the answer is management. Sometimes law also. Sometimes law also. For example, in Companies Act, you have Schedule 3. In Companies Act, you have Schedule 3. Schedule 3 says you have to disclose audit fees. Now you have to disclose audit fees separately. Companies Act Schedule 3 says any call money due from director, any call money due from director will be disclosed separately. You have to disclose separately. So therefore, sometime the law may define the materiality. And you will see in Schedule 3, they have also said individual items which is some percentage of turnover or a certain amount, whichever is higher will needs to be disclosed separately. So therefore, there are situations where the law also gives you materiality. So the answer is A and B. Okay, example of materiality. Suppose the sale of a company is 4,25,000. This is P&L account. By sales 4,25,000, and there is a expenditure on repairs and maintenance 45,000. Is the repair and maintenance expenditure material when compared to the sales figure? Yes, the answer is right. It is material because it is almost 10% and more than that. But suppose the turnover of the company, same example, suppose I change by sales 2 crore 50 lakh, sale is 2 crore 50 lakh, and 2 repairs and maintenance 45,000. Is it material now? Not material. What we can do? We can club it with other expenses. All these small item we can put together under the head other expenses. Now it is not material. Now there is no need to show it separately because the turnover is 2 crore 50 lakh. So in front of that, an amount like 45,000 may not be material, and therefore while presenting repairs and maintenance, you may include it in other expense. So management has to decide what information needs to be disclosed, whether it will affect the users of financial statement or not. Okay. So therefore, sometime judgment is required. Right here, judgment is required to decide materiality. Judgment is required to decide the materiality. Now I will revise first. I need to ask you 3 considerations to be kept in mind while choosing an accounting policy. The first one was prudence, second one was substance over form, and third one is materiality. This is the guidance given by AS-1. Now we'll discuss about fundamental accounting assumptions. What do you mean by fundamental accounting assumptions? It is assumed that certain accounting principles have been followed. It is assumed that certain accounting principles have been followed in the preparation and presentation of financial statement. These are so basic, so fundamental that every user is supposed to assume that these have been followed. These are so important, so fundamental, so basic that every user assumes that they have been followed. So which are these 3 fundamental accounting assumptions? Now one more thing, they are so fundamental that their disclosure is also not required if they are followed. So if they are followed, then disclosure is not required. But if they are not followed, then the disclosure is required. Okay? You don't have to write in your notes to account, company follows accrual method. Every damn user is supposed to assume this company follows accrual method. If you have not followed accrual method for certain transaction, then you can disclose. You don't have to disclose. We have followed our accounting policy consistently in this year, which was same as last year. Everybody knows that. Everybody knows that you have followed same accounting policy. Then when will you disclose? When you have deviated from the accounting policy. So now your institute will ask you question on this. What are the three fundamental accounting assumptions under AS-1? So the student will say first is going concern. Going concern. Okay, going concern. That means the entity is normally viewed as continuing the operation for the foreseeable future. It simply means entity will continue. In simple words, going concern means entity is going to continue. Entity is not going to shut down. At least for 1 year. At least for 1 year. Entity is not going to shut down at least for 1 year. There is no need to shut down or reduce the scale of operation at least for 1 year. It will continue. Going concern means it will continue. It is assumed that the enterprise has neither the intention nor the necessity of liquidation or of curtailing materiality the scale of the operation. So what are the points mentioned here? There is no intention to, I will erase. First thing, no intention. Second, no necessity. And third is curtailing materially. So no intention to shut down. Nowhere the company wants to shut down. There is no necessity to shut down also. Sometimes there can be necessity to shut down also. Like you have received a government contract for 2 years. There is no other contract in hand. Once those contracts are over, you will have to shut down because there is no other business in hand. So then in that case it becomes necessity to shut down because you don't have any choice. Sometimes the management may intend to shut down. They say, oh, too much. I have done business for so many years. Now I will go to Goa and stay there and do meditation in Goa. So that is intention to shut down in 12 months. So they have sent a notice to all their bankers, creditors, debtor, lenders that we are going to shut down. Or there is no need to materially reduce the scale of operation. Then it is a going concern. And if you are a going concern, don't write in your financial statement, we are a going concern. No need to write. You are a going concern. I know that. Then when will you write that going concern assumption is not there? When either there is no intention to continue, there is necessity of liquidation for any reason, or you are going to materially reduce the scale of operation. Then in that case, you will have to mention in your financial statement that the entity is no longer a going concern. And now we are going to solve question number 3 and 4 immediately. So dear student, please do not read the answer. Only look at the screen. Only look at the screen. Question number 3 in your book. A partnership firm was formed to secure the tenders floated by BSNL for publication of telephone directory in 2009-10. It backed the tender for publishing the Pune Circle for 5 years. This is 2009-10, and it has got this tender for 5 years. So 9, 10, 10, 11, 11, 12, 12, 13, 13, 14. So up to 13, 14 they will continue. It has made profit in 9, 10, 10, 11, 11, 12 and 12, 13. So it tried to get the same order from other cities, but it has not got it. It has only, its only activity is Pune directory. So now see 4 years are over. 1, 2, 3, 4. The contract will expire on 31/12/14. You are auditing the accounts of 12/13. So we are standing here. Okay, this is the auditor. He is standing here. Is the going concern assumption appropriate for preparation of account for 12/13? So I'll put a date for understanding. We are preparing financial statement for year ending 31st March 13. 31st March 13. And the contract will expire on 31/12/14. So there is a gap of 1 year and 9 months. What I have to see, whether the company is going to liquidate or materially reduce the scale of operation or materially reduce the scale of operation in next 12 months. Next 12 months are clear. There is no need, there is no requirement by the law or business constraint to reduce or close down in next 12 months. So the question is whether going concern assumption is appropriate. Yes, the answer is yes. The going concern assumption is appropriate as far as 31st March 2013 is concerned. Why? Because for next 12 months we are not going to wind up the operation. Therefore, company can assume going concern is valid. Company can assume going concern is valid. No disclosure about going concern is required. So the answer you will write like this. The going concern assumption is not in doubt as far as 2012 and 13 are considered. Is it right? This is because the assumption's validity is to be considered for the foreseeable future, and which is a period not exceeding 1 year from the balance sheet date. So as long as you are going to continue for at least 12 months, no need to mention about the fact that going concern assumption is valid or not valid. Don't make any disclosure in 2012-13. Now I am going to change the question. We are standing on 31st March 14. The contract will expire on 31/12/14. Only 9 months are left. And there is no other business proposal in hand. You have only one contract to publish telephone directory of Pune region, but only 9 months you can do that activity, and after that you don't have any other alternative but to shut down. There is a necessity to liquidate because you don't have any further business proposal in hand. So now your answer will be going concern assumption is not valid. The going concern assumption has become doubtful. Since the entity's continuation in the foreseeable future of 1 year would be doubtful in the absence of any other alternative business plan. Okay? You don't have any other alternative business plan, so therefore company will have to wind up. Unless the company can prove that they have got the other business plan. Yes. Question is, even if the company continues for at least 1 year, whether going concern assumption is appropriate? Yes, at least 12 months. At least 12 months from the date of balance sheet. If the company is going to continue, going concern assumption is appropriate. Homework, write down. Homework. Question number 5. Now we'll come to third fundamental, or sorry, second fundamental accounting assumption as per AS-1 is called consistency. Is called consistency. What do you mean by consistency? Have you heard this word consistency? Consistency. Like our class happens consistently every day at the same time, consistently. Okay, so that you have faith in the system. You will come tomorrow at the same time because you know sir is consistent. So consistency creates reliability. Consistency creates reliability. Just like a teacher should be consistent so that the student will rely. An entity should also be consistent when it comes to accounting policies. And ideally, companies should follow same accounting policy every year. Of course, there are situations where accounting policy can be changed, but in general, accounting policies should not be changed frequently. So what the user of the financial statement assumes? The user assumes that accounting policy followed are same what was followed in the earlier years. So there is no need to mention that we have followed the same accounting policy which was followed in earlier year. He will assume himself. Then when will you disclose? When you have changed the accounting policy. Always follow same pattern from one period to another. That is called consistency. Why consistency is required? Question is, why consistency is required as far as accounting policy is concerned. Why consistency is required? One, to make comparison. If you follow different accounting policy in different year, comparison is not possible, and to make financial statement more reliable. Make financial statement more reliable. These are the two important reasons that we need to follow accounting policies consistently, year after year, year after year. Can we change the accounting policy? Yes, but that we'll discuss later. Next point is third fundamental accounting assumption. First one was going concern. Second one was consistency. Third one is accrual. What is accrual? Tanya, what is accrual? Shivam Gupta, what is accrual? Anybody, what is accrual? Accrual means revenue and cost are accrued as they are earned or incurred, not as when money is received or paid. So it means income is recognized when they are earned. expense is recognized when they are incurred. The timing of receipt and payment is not necessary. The actual date of receipt and payment is not important. What is important? In case of income, whether you have earned them, in case of expenses, whether you have incurred them. Earned means right, right to receive, and incurred means you have obligation to pay. Earned means you have got the right to receive, obligation means you have incurred means obligation to pay. Okay, so that is one of the fundamental accounting assumptions. A simple example is credit sale is recorded when goods are transferred to buyer with risk and reward. When you sell goods and assuming the condition of sale are satisfied, risk and reward is transferred, you pass an entry, customer or debtor account debit to sales. What you are doing? You are recognizing the revenue because you have earned it, even though the customer will pay you later. Another example, credit purchases. Credit purchases are recorded when goods are received with rights and with risk and reward. With risk and reward. Credit purchases is another example where we make the payment later. Salary is recorded when employees render services. An entity is obliged to pay. An entity is obliged to pay. That is accrual. Okay. Once your obligation has been created, you need to record those expenses. Any other example from your side? I can give many more examples. Should we follow cash system of accounting? Revenue and cost are recorded in the financial statement of the period to which they relate. So what is the benefit of accrual method? Benefit of accrual concept. Anybody? Benefit of accrual. Why we need to follow accrual method? Why can't simply record on cash basis? That will make your life so easy. Take your bank statement. Whatever are receipt and payment in bank statement, pass entry for that. Your life would have become so easy. You would not have required any standard if this accrual was not there. Just record what is received and what is paid. So in that case, the answer is profit or loss will not be true and fair. Profit and loss will not be true and fair. Matching concept will be violated. Matching concept will be violated. Financial position will not be true and fair. Financial position true and fair is not there. So these are the challenges of not following the accrual concept, and there will be other problems also. you don't really know how much tax you have to pay to the government. Partnership firm will not know how to share their profit and losses. Can we follow cash system in some cases? Can we follow cash system in some cases? Correct, Dheeraj. It helps us to calculate current year profit. My question is, can we follow cash system in some cases? Can we follow cash system in some cases? The answer is yes. When collection of revenue or measurement of revenue is uncertain. When collection of revenue or measurement of revenue is uncertain, then in that case we can follow cash system. For example, you have sold goods to politician, and you know that this politician is not going to pay, so you will not record revenue. You will record it as revenue only when you actually collect money from the politician, or if the measurement of revenue is uncertain. So till measurability and collectibility element becomes certain, revenue is not recognized. Then in that case, revenue is recognized when they are actually collected. Another example is, in case of banks, there are non-performing asset. In case of bank, there is non-performing asset. In case of non-performing asset, interest is recognized on cash basis only when they are actually received. In case of interest, loan, they recognize it only when it is actually collected and not on accrual basis. Then one student is asking, if going concern is affected, will cash system apply? Not necessarily. You can follow accrual system and you may follow cash system for some item where collectibility and measurability is doubtful. So going concern assumption, if not valid, still we can follow accrual method, and for some item we will follow cash method. Can we change the accounting policy? Just 10-15 more minutes. Can we change the accounting policy? Just now you said accounting policy should be followed consistently year after year. However, our accounting standard cannot be very rigid. There is some flexibility given to the entities. Okay. Some flexibility is given to the entities. They can't make accounting standard very rigid. Business models are changing. Business environment is changing. Business competitiveness is changing. What was true 10 years ago may not be true today. Therefore, accounting standard has allowed you to change accounting policy, but it should be done very rarely. And secondly, there are a lot of additional disclosure requirement which you have to comply. Are you going to comply additional requirement? Yes. Then you can change. So which are the three situations? If the change is required by the law to comply with the requirement of the law, if the law says certain accounting standards should be followed, you have to follow it. If they say certain provisions are applicable or not applicable, you have to follow. Okay. So that is called compliance with the statute. For example, change in Companies Act. There is a schedule related to depreciation, if that schedule related to depreciation, it was changed some years ago, company will have to change their accounting of depreciation. Then there is a schedule 3. If there is an amendment in schedule 3, the presentation of financial statement will change. So therefore, company can change accounting and presentation if the Companies Act changes. Two example I have written: schedule on depreciation, then there is a schedule 3 which deals with presentation of financial statement. It can change. Second situation is to comply with an accounting standard. All of you know AS-10 has changed. There has been major amendment in AS-10 some years ago. Earlier there were two standards, AS-6, AS-10. Now both the standards have been removed and a brand new standard has been issued, AS-10. So companies have to now follow revised AS-10. Companies will have to now follow revised AS-10. Similarly, in future, if some other standards change, they will have to follow that revised standard. And the third is, which is a power given to management. Power given to management. Change would result in more appropriate presentation. A change would result into a more appropriate presentation. Then in that case, if the management thinks that this change would show the financial statement better than what it was showing earlier, then in that case company can change. For example, company may change inventory valuation method from FIFO to weighted average if they think this will give a better presentation of inventory and cost of goods sold. Then accounting of gratuity. When the organization is small, they don't apply actuarial method. Actuarial method is a method used by company by taking help of actuary. Actuary is an expert in calculation of liability towards retirement benefit. So earlier company was following pay as you go method. Which method? Pay as you go. When the employee will retire, I will pay and I will do the accounting. And now it changes to actuarial valuation method because the organization has become very big. So this can also be done. This can also be done. From pay as you go method, you can shift to actuarial valuation method because management can say earlier we had only 5 employees, now we have 50 employees. So my presentation will be better, accounting will be better if I do the accounting by taking help of actuary rather than just following the pay as you go method. So yes, tell me once again, revise. When can you change accounting policy? Change is required by law. Change is required by accounting standard or for better presentation. But this last point is very subjective. Management sometimes changes the accounting policy even though it may not give better presentation, but they may want to increase or decrease their profit in a certain manner. However, this flexibility is there and we can't do anything about it. But when you change the accounting policy, there are some additional disclosure requirement. What are the additional disclosure requirement? When the company changes accounting policy, write down important for exam. If the company changes the accounting policy, what are additional disclosure requirement? You have to give the effect of change in accounting policy on financial statement of current period should be disclosed to the extent it is ascertainable. Suppose you have changed from FIFO to weighted average. Under FIFO, the value of the inventory was 1 lakh. Under weighted average, it is 1,20,000. So the impact on the financial statement is 20,000. So you have to disclose in your notes, during the year company changed the method of inventory valuation from FIFO to weighted average. Under FIFO, the value would have been 1 lakh. Under weighted average, the value is 1,20,000. Hence, the profit is affected by 20,000 rupees, and in the balance sheet, inventory value is higher by 20,000 compared to previous year method. So, this is called disclosure. If you can't quantify, then that fact also should be disclosed. If you have changed some accounting policy, but you can't calculate its impact, then just disclose that accounting policy has been changed, but the effect cannot be calculated. Example of change is FIFO to weighted average. Okay? And disclose the effect in P&L account of the current period. Now, next point, disclosure of accounting policy. What we need to disclose. What we need to disclose. Just 5 more minutes for today. What we need to disclose. What we need to disclose. This is the exact guideline given by this AS-1. What you need to disclose, how it needs to be disclosed, where it needs to be disclosed. First principle, all, but all means only all significant, important accounting policy adopted should be disclosed at one place. So where do you disclose? We disclose in notes. Notes to account. If you see any annual report today, it is written notes to account. The first point is usually significant accounting policies, and then they will write down all their accounting policies at one place. And example, oh, there is a question also. On one line, one question. Question number 7. ASF Limited has disclosed accounting policy related to fixed asset in Schedule E, accounting policy related to investment in Schedule F, accounting policy related to inventory in Schedule G. Comment on this practice. So they have not disclosed at one place. This is a wrong practice. This is a wrong practice. All accounting policies should be disclosed at one place. Should be disclosed at one place, and it should not be scattered over various schedules. Schedules means note number. Note number 1, note number 2, note number 3, note number 4. So some policy they have written in note 1, some policy they have written in note 2, like this. This is a wrong policy. Okay. Next point to be remembered, any change in accounting policy should also be disclosed in the year of change. First point was all significant accounting policy disclosed at one place. Second is change in accounting policy should be disclosed in that year when the change took place. The disclosure of significant accounting policies as such will form part of financial statement. Very important. The disclosure of accounting policy is a part of financial statement. Financial statement means it is a part of balance sheet, P&L account, notes, cash flow statement. These four items together are called financial statement. It is a part of financial statement. There is one question number 8 below. With question, concepts will improve. Are you with me? Sanjay Limited follows the practice of disclosing accounting policy adopted in preparation of financial statement in, oh my God, where they have disclosed? In director's report. Director report is not in financial statement. Comment on this practice. Is it a right practice or a wrong practice? Is it a right practice or a wrong practice? So you will say it is a wrong practice because director's report do not form part of financial statement. They should disclose significant accounting policy in financial statement, that is the notes. Next important point, if fundamental accounting assumptions are followed, no disclosure is required. But if fundamental accounting assumptions are not followed, if fundamental accounting assumptions are not followed, then you have to give disclosure. For example, you will say entity is no longer a going concern. You will say entity has changed the accounting policy. You will say entity has not followed accrual method for these items. That needs to be disclosed. Okay. So in short, if fundamental accounting assumptions are followed, specific disclosure is not required. If fundamental accounting assumption is not followed, that facts needs to be disclosed. That is already printed in your book. Next point is, you see in your book, next point, any change in accounting policy. Suppose there is a change in accounting policy which has a material effect. Material effect means significant effect, which has a significant in the current period, or which is reasonably expected to have a material effect in the later period also. So it may affect current year, it may affect later years also. It should be disclosed in the financial statement. Some change may affect only current year, some change may also affect future accounting periods. Okay, in that case, make a disclosure. Make a disclosure. There is a question number 9. And one more thing you have to mention here, which I have written in your book. Don't worry. Quantify, if possible. Wherever possible, quantify the effect of change. And if quantification is not possible, then also disclose the fact. If quantification is not possible, then also disclose the fact. So there is a question number 9, tick mark question number 9. ASF Limited has changed the method of valuation in the current year from FIFO to weighted average. The change has no material effect in the current period, though it is likely to have a material effect in the next year. Whether disclosure of change is necessary. Whether the disclosure of change in financial statement is necessary. So what did we discuss? A change in accounting policy may affect current year, it may affect future year. If it is going to be material either in current year or for future period, the fact should be disclosed. If possible, quantification should be done. If quantification is not possible, then at least disclose the fact that there has been a change in accounting policy. But disclosure is necessary in the current financial statement. So this change will have to be disclosed. It can affect current year, it can affect future year. Company has to disclose about this change. So read this answer as homework. I have explained it to you. Same thing is printed here. If you have any query on question 9, you can ask me. Question number 10, note down homework. Before that, there is a statement. Disclosure of an accounting policy, however, cannot remedy an inappropriate treatment of transaction. Very good line. Suppose you have followed a wrong accounting policy and you have disclosed it. Is it justified? You will simply write in your notes to account, we have not provided depreciation on PPE. So you have written what you have done, but your financial statements are not true and fair, because AS-10 says property, plant, equipment needs to be depreciated over their useful life. So by disclosing a wrong accounting policy, you cannot justify it. Your financial statements are not true and fair. Auditor will qualify the audit report, even though you have disclosed the fact that you have followed a wrong accounting policy. So disclosure of wrong accounting policy does not mean you will follow the wrong accounting policy. There is one question also for you. A company follows LIFO method for inventory valuation and it continuously discloses this in its financial statement. Comment. Can a company follow LIFO method just by disclosing it in the financial statement? The answer is no. The reason is our AS-2 does not allow entities to follow last in first out method. The method which are allowed are FIFO, weighted average, specific identification method. Any other method will violate accounting standard 2. Therefore, just disclosure of the fact that company follows LIFO consistently is not enough. I will now show you the accounting policy disclosure of a reputed company, Infosys. This I have taken from their annual report. Okay, so today you will also check in annual report of listed company, how do they disclose their accounting policy. So this is Infosys. They have disclosed in their financial statement. Some policies I have written, otherwise it runs into many pages. They have written, this is not to be remembered. This is just an example from real life about Infosys. Financial statements are presented in accordance with Indian GAAP under the historical cost convention on accrual basis. Then revenue from software development on fixed price, fixed time frame contract is recognized as per percentage completion method. Cost of software purchase for use in software development is charged to cost of revenue in the year of acquisition. Fixed assets are stated at cost less accumulated depreciation. Depreciation is applied on a straight line basis. So this is they have disclosed. Write down homework first. Question number 11, question number 12. You will just solve it yourself. Answer is given to help you out. Now we'll solve one or two more questions for practice if you want. Otherwise the chapter is over. Can the same type of inventory at two different factories be valued by applying two different accounting policies. Now this is one factory A, this is one factory B, and this is the pen. Let us say this is the inventory. So this pen I have kept in this factory. Okay, this is same pen. Can I follow two different accounting policy for the same inventory? It's written the word same. Just because one is in factory A or location A and one is in location B, can I follow two different accounting policy? So you will say no, because it is the same inventory. I can't follow FIFO here and I can't follow weighted average here. If they were different type of inventory, this was suppose raw material and this was suppose finished goods, then I could follow two different accounting policies. Okay. So the answer is no. Come to question number 15. 14 homework. 14 write down homework. Most of you got it right. One more question I will take. Question number 15. Fixed assets are stated at a cost of acquisition or construction. So what they have done, they are valuing their fixed asset. They have added the cost of acquisition or construction, plus they have added interest and finance cost till the asset is put to use, minus specific grant received. So this is their formula for calculating the amount at which fixed asset will be capitalized. Cost of acquisition plus borrowing cost minus specific grant. Then the question says comment. So the answer is this will be capitalized. This will be also capitalized as per AS-16 and this will be deducted as per AS-12 government grant. So whatever they have done, enjoy, it is correct. If you read AS-10, AS-16, AS-12, this is what they have recommended. So therefore, the company has to follow the same practice. So in this question, the answer is what the company has done is right. Read the answer from your book. And this standard AS-1 is over. I humbly request you, please read the entire chapter today one more time. Revise tomorrow one more time, and then AS-1 will be permanently fixed into your mind. If you have any doubt, you please mail me. Okay, my personal mail ID is very simple, vinod_ca@yahoo.com. When you will send me the query, you will send the question number, page number, photocopy, photo of that question and answer and your query in detail. Okay. So thank you very much. All the best. Bye bye.